Okay, cool. Well, thanks for being here, Dave. Those of you who are on, or anyone who's going to get on, I'm super excited that we have this opportunity for um, just some more insight on what the heck happened last Friday at the Jackson Hole Summit. Some of you may have heard about it, some of you may have not. Doesn't matter because Dave is going to help us sift through all of that information. Just a little bit of info on Mr. Dave Medina here. He is a mortgage lender in the top 1% of the nation. He's been in business for over 21 years. And he is just a rock star, expert, educator in this area. And he's just a gift to have on here. So I'm really excited to see what he's going to share with us. Thank you.
Thank you, Robin. Listen, first and foremost, I want to thank you for setting this up. I think it is critical. I think sometimes people neglect to have tough conversations, even when they're very necessary to do so. And I just really applaud you to, kind of, avoid the impulse to just stick to unicorns and cotton candy and really get down to what matters. I think, as this video goes out there to your community, I think they'll be very grateful for this insight that we're about to give them today. So first and foremost, thank you to you for taking charge and having a willingness to go out and educate your clients. I think that's where you and I really match up from a core value standpoint, is that willingness and desire to educate at all costs. So thank you for that. Okay, so what happened? Well, first of all, last Friday was the annual economic symposium. It's held once a year in Jackson Hole, and this is where the Fed chief, whoever that is at that given time, gets up and they have a rather short, believe it or not, a short conversation, but very impactful conversation that really is critical in dictating where we are going as a nation from an economic climate standpoint over the next 12 to 24 months. This one was heavy. There was definitely a lot of information. It was a little confusing for a lot of people, and you know what? A lot of people, frankly, just didn't even know it happened. So again, thank you so much for having this event. I think we're going to be able to share a lot. But any areas you wanted me to kind of focus on, Robin, or?
Yeah. Well, first of all, where are we? Where are we today with the with all this economic stuff?
Yeah, I think to have a really good understanding of what is happening here today, I think it's important that we do take at least a couple minutes and go back in time and look at a little bit of the history of how we even arrived here, right? So in 2020, we had a rather impactful event happen, not just here in the United States, but in the entire world, and that was the emergence of the COVID pandemic. And it ended up being a walloping to our economy. And at that time, certainly now I'm going to really avoid this becoming a political discussion. That really has no place in the financial fact that we're going to be talking about here today. But the fact of the matter is the current administration and the previous really stepped up hard in order to make sure we kept the American economy pumping. And by doing that, they started first by basically taking interest rates down to essentially 0%. And, it's important that I differentiate for a second. When the Fed is talking about raising and lowering interest rates, they're not necessarily talking about long-term interest rates like mortgages. Certainly, they all follow the same trends, right? If the Fed interest rate is risen, then other interest rates generally rise along with it. But as a free economy, as a capitalist-based economy like we are here in America, this is essentially the only tool that the government has. And the Federal Reserve is a nonpartisan part of our U.S. government. So they are neither Democrat or Republican. They are just here for the well-being of Americans. And what they did at that time was take interest rates to zero, which made borrowing and made lending for financial institutions really easy. So a lot of money hit the street, and then compounded with that, A lot of money was printed during this COVID time. There are
Mhm.
some staggering statistics actually in regards to just how much money was printed. And I think it just comes down to basic economic principles. You cannot increase the supply of something to the tune of multiple trillions without having an effect on the value of which it is. When you infuse trillions of dollars into the economy, it's going to be spent. And spent it was, right? And what it caused was inflation. And I'm going to give you a quick definition of inflation. It's used by a lot of economists, and it seems more complicated than it really is. But what inflation really is just an increase of the cost of goods and services that we pay for. That's really it at the end of the day. So what cost $5 last year costs $8 this year. That is inflation in its purest form, right? So when we started seeing inflation, right, we all saw it. I mean, I remember one time I went to buy chlorine at Home Depot, and I'm like, what the heck happened to the price of chlorine, right? I mean, it literally went up like 30% almost overnight.
Everything, yeah.
Then the debate started. The debate started to whether or not this was real inflation, or you may have heard the term at that time, transitory inflation, right? Which would
Yeah.
suggest that this is not really sticky inflation. This is inflation that is very specifically due to things like supply chain issues. We had a couple hundred
Mhm.
cargo ships off of San Pedro Bay that we couldn't get things offloaded fast enough. And there became a big sort of political argument about that fact. And the transitory argument sort of won that battle, and they started bringing more goods into the country, and with the hopes that when the stores shelves were stocked, we would start seeing prices come down a little bit. Well, that didn't happen. And what we saw was a run-up of inflation that we have rarely seen in United States history. And it was real for sure. And so then the Federal Reserve got involved. And what's kind of interesting is that whenever the U.S. government gets involved, it doesn't it doesn't matter what color the administration is at that particular point, but they rarely work with finesse. Right, it's sort of like sledgehammer management, right? So they don't float things down gently, and they don't raise things gently. It's kind of this like brick to the face mentality. And that's what happened about a year ago when the Fed enacted one of the most aggressive rate hike campaigns that the United States has ever seen. And so today, as we stand, the federal overnight lending rate is as high as we've ever seen it before. And that's why we're seeing, interest rates for auto loans and mortgage loans and credit cards, especially, and home equity lines of credit have risen substantially over the last 12 months. Now, why would the Fed do this? Like, what purpose does raising interest rates do to cause the problem of inflation? Well, I already told you that inflation is a sign of an overheated economy, right? It's people that are out there spending, and the economy just literally gets red hot. Well, when you raise interest rates, it's like throwing a bucket of ice water on that red hot economy, right? So if Robin Daniel is shopping for a new vehicle and is out there and gets wide-eyed at the BMW dealership, right, and is making the decision on whether to buy or not, it's a lot easier to make that decision when interest rates are 1 or 2.9%, right? But when interest rates are 8 or 9%, it's going to cause Robin Daniel to think twice about that, and hopefully inspire her to save and hit the brakes rather than spend, which is in effect cooling down the economy. Okay. So we have seen that continue again over the last 12 months, and we are starting to see signs of cooling down, right? We're seeing that at the gas pump a little bit. Eggs aren't exactly breaking the bank anymore. We're starting to see, inventory, mass up at retail shops and things like that. So, we are on the path to the recovery of this. There's no doubt. But let me now take you to this meeting last Friday, because that's where the Fed gave it from their vision, what is happening. And there's really just kind of three big takeaways that you need to know. Number one, the economy has actually surpassed the growth expectations, and consumer spending as well has maintained. Not exactly a good thing when you're trying to cool the economy down. This is just indicative of the fact that Americans are out there spending. Jobs are good. They're making money and they're spending money. I mean, for those local here to the Temecula Valley, that's, if you don't like statistics from economists, just come down to Old Town Temecula on Saturday night and look around, right? Look around at the lines outside of restaurants and things like that, and go to the stores, go to the mall, right? Like people are spending like nobody's business. And again, that's not necessarily what we're looking for in this particular time when we're trying to slow things down and have prices fall.
Mm-hmm.
The second real thing to take out of Fed Chair Powell's speech is that the Fed remains incredibly committed to getting inflation under control. And they have said that they are unwilling to ease up on their very aggressive campaign of raising and maintaining high interest rates until they start seeing the inflation marker at about 2%. That's the target that they're looking for. We're closer to about 3.5% at this point right now. But at the peak areas that we were at 9%. So we have made leaps and bounds from an improvement standpoint. We're just not there. And the Fed is just not going to stop until we are there. So what does that mean, right? Fed Chair Powell was very forthcoming about the fact that this is a critical step for the Fed to take in order to keep the economy healthy long term. But in the interim here, for the next 12 months, he also said that Americans are going to feel some pain, right? And what that pain is going to come from is likely in two main areas. Number one, keeping interest rates high, and in fact, potentially even increasing them more. I think the thought of a rate decrease by the end of this year is now effectively out the window. We were sort of, initial forecasts, we're looking at fourth quarter this year to start seeing that ease up. That's not going to happen. We are well beyond that now, especially with his comments last Friday. So the markets have adjusted accordingly to that news. I don't think, frankly, the financial markets needed Fed Powell to get up there and say that. I mean, I think the writing is on the wall in pretty much every other respect of the economy. And the other area where I think Americans are going to kind of take this on the chin is some sectors of industry are going to experience more than likely some job declines, right? That is not going to be every industry out there, but there's going to be some industries that are impacted by this economic slowdown, by these rise in interest rates, especially companies that rely on borrowing money on a very avid basis to do things like cover payroll and build infrastructure and invest in their company with technology and resources and machinery or manufacturing, whatever they're in. So when it becomes more expensive for companies to operate, unfortunately, they have to trim down the staff, right? So clearly there is going to be some pain for Americans. Yeah, it's not a fun conversation to have right now, Robin, but it doesn't mean it's not critically important. Every American deserves to know sort of what's happening now and what's in store. And this is not necessarily a bad, in fact, it's not a bad thing at all. It's showing a real, just diligent intervention from the Federal Reserve to make sure that our economy stays robust and healthy and keeps us from falling into a recession or even worse. So, I appreciate in the United States of America the transparency that we have into this, right? Not everybody around the world gets the transparency into this kind of thing. And, again, just one more reason why we are the most incredible nation on this planet. And, so I'm happy to give that update. Now, I know there's still a lot of questions. There's still a lot of trepidation and potentially fear with this. But yeah, I mean, that's the deal. That's what he set as far as the tone of what we should look at for the next year to come.
Mm-hmm. Yeah, it's not super exciting, but it's important, right? That's one of the things that is very important to me, is being transparent about what's going on. So I just love that you keep your finger on the pulse of what's happening and are able to present this to us. So, I mean, you've kind of covered already how it might affect us in the future, what we can look forward to or not look forward to for the next year and a half or so? Maybe you can touch on that a bit more.
I'd like to, because I don't want to end this meeting with everybody like, oh my God, that was a big blue message. It's really not. It sounds like it is, but it's really not. So let's fast forward, right, for a minute. I really came equipped to give you just a very precise breakdown of exactly what to expect every month over the last 12 months, over the next 12 months. But wouldn't you know it, on the way to the office this morning, I dropped my crystal ball on the floor and it broke. So
Well, dang.
please understand that what I'm about to say right now is one man's opinion, but this one man's opinion is based on the leaders in this country from an economic standpoint. I definitely consider myself to be a student of my business. So I'm taking information from not only the Fed, but as well as, any and all organizations that it is in absolutely their interest to have their finger on the pulse of what's going on. I'm talking about Mortgage Bankers Association, obviously very important to me since I am in that industry. National Association of Realtors, Fannie Mae, Freddie Mac, right? All who are technically and absolutely in the business of interest rates. So what does this look like specifically for real estate, right? How does everything that I just said tie in to real estate? Because there's a lot of buyers and sellers out there who are really confused. Is this the right time to buy? Should they wait 6 months? Should they wait a year? Are property values going to go down? Are they going to go up? There's all sorts of like conflicting information out there. And frankly, for every Harvard economist that you find to say one thing, there's a Stanford economist to say the exact opposite. So it's really kind of hard to rely on the information that's out there. So I'm going to just take this down to a real like layman's perspective. And I think everybody who's on this call or listening to this call will be able to come up with some real reliable assumptions on their own, right? I mean, there's something to be said for sort of trusting your gut on this kind of stuff, but you need the information in order to do that. So first and foremost, I talked to you about what's going on from an economic standpoint here, and it's really important because these things are for real. However, there is a very important additional underlying economic event that is happening right now specific to housing, right? Understand that when Fed Chair Powell got up there, he wasn't talking necessarily about housing specifically. He's talking about the U.S. economy as a whole, right? So let's talk about housing, right? It's what you work in, it's what I work in. And if there's ever a place that we need to be an authority on it, it's there. So the principle that I want to talk about is a principle that we all learn as a young child, right? And that is the basic law of supply and demand. So right now, as of July, which is the freshest data that's out there right now, the United States had 646,000 active listings for sale in the United States of America. That sounds like a big number. It is a tiny number for the United States of America. In order to even have an equilibrium in this in real estate, where it's not necessarily a seller's market, it's not necessarily a buyer's market, we would need to see 3 times that amount, right? We'd have to be in the like 1.5 million range, and that's not high. That's just where we need it to be to establish kind of an equilibrium. So we have the biggest inventory crisis that we have ever seen in the United States of America, right? Yeah. So let me tell you, I get calls all the time, right? Because I'm constantly pre-approving people, educating them. And one of the things that we do that I think is a little bit different is we don't wait for somebody to want to buy a home to get them ready. I believe that runway is the most important tool and asset that we have when somebody is considering home ownership. So if they are looking at buying a home anytime in the next 12 to 18 months, right now is the time to get started, right? And get all your ducks in a row, make sure our credit profile is optimized, make sure our debt profile is optimized. And that's where we really step in. So I have a lot of these conversations with people that really have no desire to buy a home until maybe a year from now. And so I was talking to a young couple earlier this week, and they said, "Oh, Dave, we're so excited. Thank you for the pre-approval. We're super pumped up. Now, all we're going to do is wait for all these foreclosures to hit the market, because they certainly will be. My mom and dad told me this is going to be the most prolific opportunity because it happened to them when they lost their home back in 2008 and 2009. And literally, like, my heart broke hearing that, because people are getting so much poor information, and it's coming from people that really love them, and they're trying to protect them. from some of the kind of atrocious things that happen to them in housing, and a lot of the children of parents who back in 2008 and 2009 really were severely impacted to the way of losing homes to foreclosure, are now becoming of buying age themselves, right? So they still sort of feel the stings of that. They had to move schools, they had to pack up their room. I mean, it was a very kind of tumultuous time for people. And parents don't want their kids to have to go through that as well. So they're saying, no, this looks, smells, and feels exactly like 2008. Don't do it. But there is a very important thing to consider. Those that are waiting for the foreclosure market to hit, I want to just very plainly explain something to you. Americans are sitting on trillions, that's a T, many trillions of dollars of home equity that was spurred specifically by the last 3 years of the most aggressive run-up in home appreciation that frankly we have ever seen before. So what happens? Why does somebody let their home go into foreclosure, right? They have financial stresses, maybe there's job loss, maybe they had a poor loan that continues to adjust and the interest rates are going up and up and up like it did prior to 2008 with the emergence of the subprime market, right? Fast forward to now, people have hundreds of thousands of dollars of equity, Robin, in their homes. So if somebody had the unavoidable things like job loss, right, or death, or things that are traumatic that would in other times maybe lead to foreclosure, what they would do instead today is call you, Robin, right? You would have that home listed in 3 days. And in your estimate, how long would it take that house to get into contract and sold?
Well, in my experience, it's happening really quickly, a weekend, 5 days. I mean, like really quickly. We put an offer in on a home last week and there was about 6 other offers as well. So it's still competitive and pretty hot.
Yeah, at the highest interest rates we've seen in 22 years, there's
Yep.
still 6 offers on the table in one weekend of the property being listed. So back to the foreclosure discussion, right? Who on earth is going to throw their keys back to the bank when they can call a realtor and have a couple $100,000 sitting in their wallet in 35 days, right?
Right.
So those of you that are waiting for the foreclosure boom to happen, I hope you're sitting in a comfortable chair, because it's going to be quite some time before we see anything like that. There are zero economic indicators to suggest that that's what we have in our future. So as inventory remains low, the law of supply and demand will prevail. So home prices are actually forecasted to maintain and in some markets actually increase during this time, right? And as we see, interest rates are high right now. There's no question about that, which is not fun. But as the Feds move to quell inflation, and they just told us their staunch commitment to do so yet again, even at the expense of pain for some Americans, right? We are going to get this accomplished. I believe we are. We're already seeing it. I mean, from 9 to 3.4, that's a big decrease. 2 is the target. We're not that far away from that. So I want to tell you, all of you listeners out there right now, I want you to use in your best estimate. We just right now interest rates are somewhere in the realm of 7.25% to 7.5%, depending on the borrower's profile, down payment program, things like that. And out there today, evidence of just this last weekend, homes are selling over the course of a weekend with multiple offers who are bidding the property value up. And that's at an interest rate of 7.5%. What do you think would happen if I did a massive press release tomorrow and said, hey, great news, everybody. Interest rates went down from 7.5% to 6%. It is going to be buyer melee out there. You're going to see a flood of buyers hit the market that will be equivalent to what we saw during the COVID environment, right? All the fence sitters right now that are hesitant to buy at 7.5 are going to pull the trigger, right? What if it went to 5.5? What if it went to 5? Right? Which I'm not saying is going to happen in the next 3, 6, even 12 months, but interest rates are going to come down. And when that happens, you have to ask yourself, are homes going to be cheaper than they are today, or are they going to be more expensive? So there is a potential win in housing even in the, in the light of these incredibly high interest rates and property values being high, it's really affected the affordability for people, but we're making it work every single day, right? There are strategic ways that we can structure these offers in order to kind of soften that blow to buyers. That's one of my strengths, is sort of the art of the strategy of how we're positioning that offer. Um, um, but I think there is something said to buying the house today and refinancing in the future. I think there's this mental perception that interest rates somehow are like lifelong shackles. Prior to COVID, the average lifespan of a mortgage between refinances was less than 4 years, right? So all of a sudden we've flipped this switch and we're like, oh, this is a 30-year death sentence. It's really not. So, you just have to ask yourself a simple question. Is it better to buy the house today at 500,000 at a 7.5% interest rate, or potentially wait 12 months and buy it at a 6.5% interest rate, but pay $550,000 for the home? I mean, it's definitely a matter of perspective. Robin, I've been working with buyers for multi generations. I have the privilege over the last 21 years of serving buyers 2 decades ago, and now I'm working with their kids, and in some instances their kids' kids, which it's an honor to be in this business. It's an honor to provide some help in financial planning. But the one thing that I've learned over that 20 years, Robin, is that, look, statistics are what they are, and statistics don't lie, but liars use statistics all the time. A wise man once taught me that. So the right time to buy for a family is when it's the right time for that family. And every family will have different short-term goals. They will have different long-term goals. But I'll tell you, the value of your home only matters on one day. And that's the day you have to sell it, right? That's the day you have to sell it. Every other day in between that day is just the day that you celebrate birthdays, the day you celebrate Christmas, the day that you have the most momentous milestones in your life, right? There's such an incredible thing. And what we know historically is that regardless of when you buy, even people that bought their home in 2007, which is arguably historically the worst time you could have ever bought a home, and they decided to keep their home, even throughout the big foreclosure run, right, are now have made money on their home for values today. They just had to wait it out. And that's always the solution. So when housing is right for you, it's right for you. But I think it's important that you have the right data, right, to make that decision for your family. And that's where people like Robin, people and myself come in. So it's certainly not a doom and gloom message, Robin. It could be a message that is packed with advantage for future homeowners. You just got to be educated. You got to know what's right for you, and you got to know when it's right to pull the trigger.
I love that. That's true. That's what we say all along. But thank you again so much. We're coming up onto 30 now, so I'm going to go ahead and wrap up. I really appreciate you taking the time to dive into those statements from the symposium last week. I know this was a lot. This was a little bit on the longer end for those of you who are attending in the future. We will definitely do this. I think it would be great to get an update again from Dave in a couple of months. So if you would be willing to do that for us, that would be awesome. We'll keep it maybe a little shorter then, which is great. But this was a lot. It was, the annual statement. So just a lot to unpack.
There's not much to talk about.
Right. Well, yeah, anything else?
Only that, we're here to educate and empower people. There's no cost or obligation whatsoever. So if you're interested in how everything we talked about today impacts you specifically, just reach out to Robin. I would love to connect and talk to you about this a little further, and more in particularly about how this might affect you. So she's got speed dial. It's wonderful to work with a partner like her. So I hope I get to connect with you guys.
Yep, Dave's the man. He's so wonderful. I'm really appreciative again. Thank you for getting on this, and thank you all of you for listening. If you have any questions, let me know, and I will be so happy to get you connected with Dave. All righty, thanks.
Guys.
Bye. You too.